Hi, welcome. This is a makeup lecture for the factor model. So what is the learning objective of this class? So first we try to understand what is a factor pricing model, and then we will learn the four commonly used factor pricing model. So the first one is a single factor model. It's invented by Sharp, also known as CAPM, Capital Asset Pricing Model. I guess you have learned that in your 3000 classes. That CAPM basically sets risk and expected return trade-off. Okay, if you're willing to take more risk, then you expect the return will be higher. The second model we are going to talk about is Pharma French three-factor model. This is an well-cited paper, most well-cited paper in finance, and basically extend the CAPM model to include two other more factors. One capture the size effect, the other capture the value effect. We'll elaborate that later. And the next one is CAR4 model. So CAR4 factor model basically include momentum into the Pharma French three-factor model. So it means that it includes a new technical analysis element there. The last one is five-factor model, recently invented by Pharma French again. So what they think the CAR4 factor model based on momentum is not a good factor, because momentum is, they believe, is not fundamental enough. So they consider other two-factor model based on the three-factor model. One we will elaborate later what are the additional two factors. Now let's start with pricing equation that is fundamental in asset pricing. So we have a no arbitrage condition, then we will have a pricing equation, and when the pricing equation satisfies certain sub-property, then we will have factor pricing model. So let's start with a consumption-based pricing equation. We'll consider a very simple model. It's very similar to macro. So we consider two-period model. So there's a consumer whose utility is separable. So we can see big U is a function of today consumption CT, and tomorrow consumption CT plus 1. So it's a function that's separable between today's utility, small u of C of t, and plus the time discount factor beta times expected value of the future utility. And note that beta is a subjective discount factor. So now to proceed, so let's consider ET and ET plus 1 are equilibrium consumption that without financial market. Okay, so this is they would maximize according to certain kind of objective function, and there's some restriction. Okay, we don't specify what it is, but that's what we have. And the next part is to consider if financial market is available. So what happened means financial market means the agent can buy 1 unit of assets at time t at price p, and expect the payoff. Okay, the future payoff is uncertain, stochastic, is xt plus 1. Okay, so they can buy as many as they can. So what the agent is going to do is to choose I, t, okay. Then the utility of the agent will be, you can replace the consumption. Okay, so it's ET is original one, but now they would try to do investment, so it's minus PT times I, and the future will be the XT plus 1 and times IT. Okay, so it's easy. FOC will be just differentiate with respect to this and that, and you differentiate this, use the chain rule, you give you this thing. Okay, because remember this thing is C of t, and then when we differentiate, the beta can take in, so it's C and we can also use the chain rule. Okay, so while you can differentiate within expectation, remember expectation is just basically integration or summation, so you can do this carrying, and by dividing this is known today, so you can divide the other side. Okay, so we have this pricing equation. So that is what we have, is the pricing equation is today's price, okay, is equal to expected value, okay, of future cash flow with we call the stochastic discounting factor, which is given by subjective discount factor times rate of marginal utility of tomorrow and today. Okay, so this suggests, okay, in general actually be true, beyond this excess consumption-based pricing equation is the price today will be equal to expectation of future cash flow with a certain kind of, we call, stochastic discount factor, that can depend on data and also depend on parameter. Okay. Now here we are going to talk about the factor models. Okay, so how factor models related to what we have before. So if remember we have this f function. Okay, if this f function is a linear, so suppose m is equal to a plus b vector product f, so it's a linear. Okay, then we have pricing model also linear, its expected value is a constant, will be there be some factor lambda is also a vector times a beta, and beta you can imagine is in the case of lambda is just one element and we use the market return. In fact, this is the beta, it's a common thing we learn. Okay, so finally let's talk about example that we can derive for the stochastic discount factor. So consider the special case that U of C is a 2-period contrastic discounting utility. So it's a negative 1/2 C minus C star square, C star being an ideal consumption, so more than that is not good, less than is not so good. So it's an inverted U shape with C star at the top. There's a C star at the optimal point. Okay, so you can see the best case for this utility is 0 because it's negative, right? It's square, and other than the ideal consumption C star, utility gives you the -1. Okay, on if you more than C star or less than C star, and symmetric. So if you use this small u quadratic utility function, so we have the big U like this, and by some calculation we can do it easily, right? Stochastic discount factor will be this, as we recall, and the marginal utility can be bigger square, can take it down and you become this. Okay, the two is cancel out. So now we have assumed we have some initial wealth WT, and tomorrow's consumption will do, because just leave 2 period, will be the tomorrow's wealth, and tomorrow's wealth is what? Is today's wealth subtract the consumption, so this is investment, and you put this is the return. Okay, so that's what we have is the stochastic discount factor is equal to beta. Okay, this CT plus 1 replaced by what we have RT plus 1. Okay, and then this is what we have. Okay, we place this to here. Okay, and then you rewrite it, decompose it into 2 parts. Okay, when you decompose in 2 parts, then you can see the first part. Okay, it's a constant independent of future, and the second part is dependent on the future, right? So you can see discount factor depend on something is independent on the future, so basically everything depends on t, and this is a factor only depend on t, it's also constant, and this is a future return. So okay, so we have the simplest factor model. So now let's get started with a single factor model. So single factor model we know is a cap M. So basically it's just saying that the return is a linear function to plug a constant term and a term proportional factor. So when the factor is equal to the market return, okay, that will be a CAPM model. So CAPM model formally will be the excess return of security will be a linear relationship with the market excess return, and this is a sensitivity to it. So okay, this beta I, okay, and alternatively, if we run the regression, we can write the covariance over variance, okay, and basically CAPM said if you higher risk, you will have a high expected return, and empirically, what we call the security market line, so we call that all the beta over time and all the stock return, and then you will see the good linear line. So it means CAPM is a nice explanation of stock variation by the betas. And how do we use CAPM to do investment? Okay, there are two ways. One way is comparing the rate of return using CAPM model. Okay, so what we do is CAPM give us the historical beta and one SML, and then you give the what's required for it. And from the fundamental analysis, you might have some rate of return. Then by comparison, then you see what to buy. Directly, you can use a pricing equation because the return is basically the change of price equal to risk-free and plus the market premium. So when you have beta, okay, then you can basically back out this price equal to this function. Of course, this thing is known, the denominator is well known now, but the numerator is not, okay. So we need to re-estimate this still, but we can use fundamental times technical analysis, know the future stock price, and then by discounting it, and then we have today's price. Of course, you can imagine this price is some target prices, okay, from DDM, for example, okay. And so CAPM is good as it explains 7% of variability. However, it does not explain everything. So there are a lot of anomalies. Say there's a reversal of long-run return. So today is low, okay, then you have a higher future return, and the short-term return tend to continue. We call short-run momentum. Okay, there are a lot of other things like book to market equity premium, size premium, earning price premium, cash flow premium, and past sale growth. Now let's consider the French three-factor model, and it is one of the most famous papers the recent 30 years in finance. So three-factor model basically improved the CAPM model by capturing two anomalies. One anomaly is value versus growth, and they consider value stock premium, okay, which said companies that have high book to market value tend to perform better than companies have a low book to market value, okay. And the other one is size of firm effect, SMB. So it suggests that small firms with a smaller capitalization tend to perform better than larger firm, okay. So the factor price model and basically said, okay, this part is very similar to CAPM, but we have a SMB and XML, okay, they have their respective sensitivity for each firm. And how can you estimate this? Is to run the time series regression, okay. And over time you have the excess return, and you run it over it, and then basically explain 90% of the return. So remember, CAPM is 7%, and three-factor now have 90%. So pretty good. So the next thing is look at how the empirical foundation, and the following portfolio shows some we can explain by beta. Okay, what they do is to consider 25 portfolio, and you divide them into portfolio that with different sizes, okay, and different values, okay, and this means a portfolio that is small in value and small book to market value, okay. Then you have 5 to 5, your 25 portfolio, and turn out to be very interestingly, you can see the return, okay, when the capitalization goes up, so it goes up and means capitalization getting smaller, actually return tend to go up, right? And when the book to market values goes up, okay, then also the expected return goes up, okay. How they get this portfolio is, okay, every June, okay, they look at the size and book to market ratio, okay, and then go to the next January and group them into one portfolio, okay, and then you can see that this is the return, okay, and you can see this can't be explained by beta. So now we're going to talk about how to construct the in this SMB and XML, okay. How do we do? So consider the 10 different book to market value and 10 different sizes, okay, and then what we have is we have 100 portfolio, okay. Then this is called small value portfolio, big value portfolio, small neutral, big neutral, small growth, and big growth. So basically this is big, this is small, this is value, neutral, and growth. So SMB means small minus big, okay. So what does that mean? Means small minus big, so the average of this three minus this average of this three, and high minus low, which means this high value and this low value, average of the high value minus average of the low value, okay. So this is high minus low. And this three-factor model is interesting because it's also related to the old puzzle called sales premium puzzle. So consider this classical problem is you have two companies. One company have a growth in sale like crazy, like Google, and there some company with drops in sale like Sears is not doing very well. So sales premium puzzle that you suggest you should buy company with dropping sales, weird, right? So that's why they call puzzle. And do I know the reason why? No, because this come from empirical result, but this is really known as a classical good stock and good company fallacy. Good company doesn't mean good stock, okay. Sometimes bad company is a good stock because they're undervalued. And you will see cap M beta cannot explain this sales premium puzzle, but three-factor model actually capture it because sales premium actually seems like a value stock, so you cannot consider sales premium as another form of value premium, okay. And the next thing is factor model going to explain what we call the short-run momentum and long-run reversal, okay. So in the stock actually shows a reversal, okay, from 5 years ago to 1 year ago is a long-run reversal, but there's a short-run momentum from 1 year ago to now, okay. If they have been going up last year, then you've been going up too, but you have been going up for the very long distance of time, but you tend to go down, then it's a long-run reversal. And three-factor model kind of explain that, and the value effect actually kind of capture the long-run reversal, but short-run momentum is not captured by the three-factor model. So now come to end, we have a 4-factor model and 5-factor model. So the momentum up and down, look at the last year, the return up, and look at the return down, okay. Look at see how it differs, and it actually can help you to predict better. And you can actually predict in the last slide, okay, last slide, a momentum is not captured, so if you explicitly included momentum, actually it performed better. But recently Now, Pharma French dropped the momentum, and think there should be consider more fundamental side of stocks. They call quality factor, and also the investment factor. Okay, the quality factor include profitability and investment. So profitability, we said look at the company with high operating profit and operating profit, which those mean those companies doing better, and look at how manager they invest. If this is the agency problem, so if the manager invests a lot, actually bad thing. So company tend to invest conservatively, tend to do better than those who do aggressively. Okay, and one example in agency model said manager actually tend to destroy value as they want to build a big empire, big office. Okay, so they're not really maximizing shareholders' profit. So if you run it, of course, you have similar equation, but you have two factor, then actually it perform better. Okay, couple conclusion. So we have go over all the factor model. We know the factor model basically can be coming from capital consumption based pricing, and when the stochastic discount factor is a linear form, then we have factor model, and we give you a constructed utility and show you it's possible, it's easy to derive a CAPM model. Okay, and CAPM model basically say this the easiest factor model. It's only one factor. It's trying to explain the individual stock variability by the market return, and each stock they have their own sensitivity to this characteristic. So basically what it said is risk return trade-off is standard thing we know. And the next is we have Pharma French free factor model. So basically this one is very well cited, as we said, and more or less it's like fundamental analysis, because it looks like size matter. Means actually small company tend to be more riskier. We know like startup is like smaller and bigger firm is more like stable, so it reflects some of that. And cheap stock better, means the value stock actually is good, it's not overbuy. And a free factor model is extended to 4-factor model, is like technical analysis include momentum. But 5-factor model go back to fundamental analysis, consider probability matter, and how agency problem is captured by the investment attitude. So this is the end of the factor model. Thank you for listening.